All right, in this lesson, we're going to talk about life insurance. Many people, they want to provide their families with protection after they die, so they buy life insurance. So if something happens to them, it provides cash benefits to whoever they name, which would be called the beneficiaries. Life insurance premiums, it's the amounts you pay for the policy. So you can pay a monthly premium, quarterly, semi-annually, annually. It's the amount you pay for the policy. Premiums, they're based on many different factors. Your age is the biggest one. How healthy you are, or unhealthy for that matter, will also come into play with what your premiums might cost you. The death rates, how long are you expected to live? These are called mortality rates. You can find those in a mortality table. It tells you basically what, on average, how long you are expected to live based on your current age and your overall health. So there's different types of life insurance. You can buy term life insurance. Term life insurance runs for a specific term or a specific amount of years, usually 5 years, 10 years, 20 years. You can buy it for a specific amount of time. Group term life insurance, you can purchase through your employer. They're covered as long as you work for that employer, then you can purchase that. The benefit is usually with a big group like that, your premiums will be lower. You can get the same amount of life insurance, but for a smaller cost. The other big one is whole life insurance, which covers you basically until you pass away. But it also has another feature. It basically combines a life insurance policy along with an investment feature. So as you pay your premiums in, part of that goes to the insurance portion and part of it goes to the investment portion. The more money you put in, and the more money you got working for you. And it's going to have what's called a cash value, which means it's going to have a value that you could actually cash in if you wanted to. Those are the main types of life insurance. Let's look at some examples. Jack is 40 years old. In 10 years, his house will be paid off and his daughter will have completed college. He wants to take out a 10-year level term insurance policy with a face value of $750,000. The monthly premium is $76. What will Jack's total cost be over the 10 years? Well, 12 months in 1 year. So over 10 years, that would be 120 months, so 120 payments. So we just multiply 76 times 120 to get 9,120. That was pretty easy. Logan purchased a whole life policy with a face value of $100,000 when he was 28. The annual premium was $C. He wanted to increase the face value to $250, so he had to apply for a new policy. Since his current age was higher, and he had some health issues, the premium increased to X dollars. So his monthly premium went up from C to X. Express the percent increase algebraically. Well, remember, you take the difference in the two, divide by the original, and then multiply times 100. We were doing this the first month of school. So take the new amount minus the original amount, divided by the original, times 100, and that will give you the percent. So to see it in action, Gabriella's whole life premium increased from $123 to $166 per month when she increased the policy's face value. Find the percent increase to the nearest percent. Take the new minus the old. So 166 minus 123 divided by the original amount and then times 100. So 166 minus 123 is 43. 43 divided by 123 is that decimal times 100. It says to the nearest percent, and that number is 34.9, so that would be 35%. So she had a 35% increase. Mario has a universal life insurance policy with a face value of $250. The current cash value of the policy is $8,260. If the premium is $97 per month, for how many months can the cash value be used to pay the premium? So he's going to, instead of paying the premium out of his pocket, he's going to use the cash value to pay this $97 per month. Well, take this and divide by 97 and you get 85 and that decimal. The greatest number of payments the cash value can cover is 85 payments. So 85 months. All right, let's look at this. Joe is an insurance agent. Zach, a 45-year-old man, inquires about a life insurance policy. How can Joe assess the risk his company is taking on when they offer a life insurance policy to Zach? Joe uses the mortality tables, the life expectancy, which was created by the insurance company actuaries. The death probability is the probability that a man of a given age will die before his next birthday. Recall that a probability is a number somewhere between 0 and 100%. It can be expressed as a percent, a fraction, or a decimal. Joe finds a probability of 0.003732 for a 45-year-old male right here in the table. This means that there is, on average, a 0.37% chance. Remember, we moved the decimal 2 places? So 0.37% chance, less than 1%, of a 45-year-old man dying before he reaches age 46. Zach's rate will be based on this probability. His premium rate is, and the type of policy he wants, his overall health, where he lives, and how much coverage he wants. The mortality rate for a certain female elderly age category is 0.043. A company insures 7,000 people in this category. About how many of them will die before their next birthday? Well, if we move the decimal place, that would be 4.3% of these people. 7,000. Actually, you can just multiply 7,000 times the decimal version, and that would give it to you as well. So 7,000 times 0.043 is 301. So they can anticipate 301 people out of these 7,000 dying before they reach their next birthday. That's how the mortality rates work. All right, let's see. The Umbrella State Insurance Company sells a 5-year term insurance policy with a face value of $150,000 to a 40-year-old woman for an annual premium of $648. What is the profit the company receives from selling this policy for each age of death? The company collects $648 per year for this term policy. If the person dies within the policy period, the company loses a lot of money on the policy. They will have collected much less in premiums than the $150,000 in benefits they would have to pay out. If the person dies after a year of payments, the company's revenue for this policy is $648, and they have to pay out the $150,000. Subtract to find the profit. So, if a person dies after a year of payments, the company's revenue has made $648. But if once they pass away, the company has to pay the life insurance policy out for $150,000. So after a year, they've made $648 in premiums, but if the person passes, they had to pay out $150,000. So their profit would be a negative $149,352. The profit is negative, showing that there was a loss of $149,352. After 2 years of payments, well, you get $648 times 2, and then minus the $150. And you can see, as the years go by, the company is less and less in the negative. At an age of 46 or greater, the term policy is ended, and the profit is found by multiplying the annual premium by 5 years. So at the age of 46 or greater, the term policy is ended. 5 times 648 is 3,240. So the company makes a profit of 3,240 if the person does not die during the 5-year term. So remember, in the problem, it was a 5-year term insurance. So from 41 to 46. That's why this table here, see, if they die within the first 5 years, the company's going to lose money. But after 5 years, the term policy is over. So they are no longer on the hook for this $150,000, but the customer has paid in $648 every year for the 5 years. So then the company would profit that much money. So let's look at one more table. In example 5, you witnessed how the company takes on a great risk when they sell a policy. See these numbers here. If the person dies before 5 years is up, then the company loses a lot of money. The mortality rates and the amount of profit are shown in this table. If the company sold 10,000 of the same policies, what would their expected profit be for the 10,000 policies? Notice the sum of the probabilities in the table is 1. It's not exactly 1, but it rounds up to 1. The expected value is the expected profit based on the probabilities. Add the products of each profit and its probability. So this number times this number, plus this number times this number, plus this number times that number, plus this number times that number, plus this times that. Add all of those up and you get $866.40. So the expected profit per policy is $866.40. This is an average. It cannot occur for one policy. If the company sells 10,000 policies, if this was for one policy and they sell 10,000 policies, then the profit for those would be this number times 10,000, which would be $8.6 million, $8,664,000. So you can see if they sell 10,000 policies, they've made a lot of money. Okay, life insurance.